Profitability is one of the fastest ways to judge whether a business model is healthy or heading toward trouble. CFO, controllers, and financial leaders use profitability metrics not just to analyze performance, but also to make decisions about pricing, hiring, product strategy, investment, and long-term planning. In today's video, we're going to how CFO read profitability in minutes. Before we dive into calculations, it's useful to understand why profitability metrics matter to a CFO. These numbers directly affect product strategy. Which product lines should continue? Which should be discontinued? How should pricing change? They also impact hiring decisions because a company with weak profitability cannot expand payroll without increasing risk. Profitability shapes broader business decisions too, including how much to spend on marketing, where to set up operations, which suppliers to use, and what level of investment is sustainable. So, unlike vanity metrics such as revenue growth, profitability metrics reveal the true financial engine of the company. To make this concrete, imagine a simplified income statement. Our example company reports total revenue of $800,000. The cost of goods sold, also called COGS, is $320,000. Revenue minus COGS gives us gross profit, which in this case is $480,000. Below that, we have operating expenses of $210,000. Finally, after subtracting interest and taxes of $120,000, the company ends the period with net income of $150,000. Now we calculate the first metric, gross margin. Gross margin tells us how much money the business keeps after it sells a product and pays for the direct cost of producing or delivering that product. The formula is revenue minus COGS divided by revenue. In our example, revenue minus COGS is $480,000. Divide that by total revenue of $800,000 and we get a gross margin of 60%. That means for every dollar of revenue, the company keeps 60 cents before covering operating expenses, taxes, interest, or anything else. What insight does that provide? Gross margin focuses exclusively on the product or service unit economics. It answers questions like, is our price too low? Are production costs too high? Are suppliers overcharging? Are ingredients or components inefficient? If a company sells a product for $1 but spends 75 cents producing it, there's only 25 cents left to cover everything else. For many businesses, that's not sustainable. On the other hand, a high gross margin gives the business more room to fund marketing, payroll, research, and overhead. However, a CFO does not stop at calculating the number. They benchmark it. For example, a 28 to 35% gross margin might be strong for a food manufacturing company, while software companies often operate with 80 to 90% gross margins. Benchmarking avoids the mistake of viewing profitability in isolation. The number only has meaning when compared within its industry. Next, we calculate profit margin, which is sometimes called net profit margin or simply net margin. This metric looks at the bottom line of the business after all costs have been subtracted. The formula is net income divided by revenue. Using our example, net income is $150,000. Divide that by revenue of $800,000 and we get a profit margin of 18.75%, which we can round to 19%. That tells us that for every dollar of sales, the company ultimately keeps 19 cents in true profit. Where gross margin evaluates products, profit margin evaluates the entire organization. It reveals how well leadership manages selling costs, marketing efficiency, administrative overhead, payroll, research and development spending, depreciation schedules, interest costs, and tax strategies. A company can have a healthy gross margin, but a weak profit margin due to high marketing expenses, bloated payroll, poor pricing discipline, or expensive debt. Profit margin exposes weaknesses that are invisible at the gross margin level. For example, imagine a software company with an 88% gross margin but only a 12% profit margin. That gap signals that operating expenses are consuming most of the potential profit. It might be spending aggressively on sales and marketing, hiring ahead of revenue, or carrying expensive debts. A CFO will investigate each cost category rather than assuming the problem is pricing or cost of production. Let's break down the core insights CFOs extract from these two metrics. Insight from gross margin. Gross margin reflects production efficiency and pricing power. If gross margin is low, the CFO might consider raising prices, negotiating cheaper suppliers, improving manufacturing processes, automating labor, reducing packaging costs, or redesigning the product. All of these actions target product-level economics. The CFO evaluates whether customers are willing to pay more, whether direct costs can be lowered, and whether certain product lines should be discontinued. Insight from profit margin. Profit margin reflects the overall financial efficiency of the business. Weak profit margin might come from high advertising costs, inefficient sales operations, expensive office locations, poorly controlled administrative expenses, research spending without return, heavy depreciation from capital-intensive assets, or high interest due to debt. CFOs will challenge department leaders to justify spending and prove return on investment. They will also examine tax strategy, loan refinancing, and leasing versus buying decisions. Now, let's summarize the key differences between the two metrics in plain language. Cost bases. Gross margin uses only COGS. Profit margin uses all expenses, including operating expenses, depreciation, amortization, taxes, and interest. Focus area. Gross margin measures product profitability. Profit margin measures business profitability. Insight. Gross margin reveals pricing and production efficiency. Profit margin reveals management and operational efficiency. Influence. Gross margin influences product strategy. Profit margin influences company-wide strategy. Because of these differences, CFO never treat gross margin and profit margin as interchangeable. They serve two different purposes and together paint a complete picture of financial performance. Understanding these two metrics also helps entrepreneurs and managers make smarter decisions. If you found these concepts helpful, share them with someone building or managing a business.